Hey there, everyone. Dave Keller here with Market Misbehavior. Excited to share with you today my favorite dividend plays for February 2025. If you've been following the markets and if you found my channel, you probably have been, hopefully, with my market recap show called Chart This with Dave Keller. We've recognized what we call changes of character in the current market environment for equities. Stocks moved higher generally December, January, February. However, a lot of bearish momentum divergences, a lot of breadth deterioration has really been the story of the markets here in February 2025. And now, as we go through the last trading week of February 2025, we're starting to see some significant breakdowns, right? Stocks like Amazon, Tesla, of course, some of those previous leadership names really failing to hold key support levels, seeing breakdowns in small caps, seeing rallies in the bond markets, which suggest investors are rotating away from kind of the growth trade of 2024 into other things. Today, what we're going to do is talk about a bit of a defensive rotation that we've identified and how we can focus on particular dividend opportunities. Stocks that have a better income potential tend to have lower volatility. So if we are going into a period of market weakness, these are the types of stocks that tend to outperform. And given their income component, they can be a great safe haven that you can use to ride out periods of market uncertainty or market instability. Special thanks and shout out to my friends at Seeking Alpha for supporting the channel and supporting this video. I'm a huge fan of Seeking Alpha. I've used their products for some time now and did use the Seeking Alpha scanning engine to actually identify some of the ideas that I'm going to be sharing with you here today. By the way, Seeking Alpha and Situational Awareness, both with the same letters. Also my own firm, Sierra Alpha, with the same letters. Anyways, let's get back to the charts here. We're going to start with a chart of the relative performance of what I consider the four kind of defensive sectors, right? When you think about the 11 S&P sectors, I kind of generally group them into three buckets. Once you have when you have sort of growth sectors like technology, communication services, and consumer discretionary. You have value or cyclical sectors, things like industrials, materials, financials, and energy. Then we have a group of defensive sectors, and I would say these four are about as good of a representation of defensive sectors as I think you'll find: utilities, healthcare, consumer staples, and real estate. Now, why are these sectors considered defensive sectors? Where generally speaking, and there are some aberrations in here, right? There's some little bit of inconsistency with the sector like healthcare, which actually has quite, some quite volatile areas like biotech. But generally, when you think of healthcare, you think of like big pharma. You think of utilities, you think of like electric companies. And we think of consumer staples, beverages, tobacco. Think of real estate. These are, sort of long-term, low volatility plays. The idea with those sectors is that they tend to have a lower volatility or a lower beta, which means if the markets start to go down, if the S&P and the NASDAQ start to struggle, these sectors tend to do better than other sectors because they don't tend to move as much. So if everything's kind of going down, these things just probably go down a little bit less. The other part of that is the income component or the dividend component. These four sectors tend to have the highest dividends and certainly higher dividends than a lot of those other sectors, particularly the growth sectors, which tend to have little or no dividends as part of their value proposition, I guess, for equity investors. They're focused more on price appreciation. These stocks that we're going to be talking about kind of have a mix of price appreciation or capital growth and income or dividend performance as well. So these are great opportunities to ride out a period of market uncertainty when the market conditions tend to get a little more challenging. Institutional investors that have to be fully invested, right? If you run a $10 billion mutual fund, you probably have to remain fully invested. You can't just sell your stocks and go to cash and ride things out. You have to own stocks. So what do? If you're worried about the markets going down, you get into defensive areas in the market that will allow you to outperform, hopefully, and ride out a period of market instability. Then once market conditions start to improve again, you can reallocate back into more offensive sectors like growth sectors, like cyclical sectors, like small caps, and ride those to new highs. So having said that, are we seeing signs of deterioration? Well, we've covered on our channel quite closely some of the signs of concern that we've identified with momentum divergences and breadth deterioration. But one of the other items on my market top checklist, which I'm starting to feel pretty confident checking off, is an improvement in the relative performance of defensive sectors, because it speaks to what I mentioned earlier. When sectors like utilities and healthcare and consumer staples and real estate are all improving on a relative basis, that suggests that idea that investors are rotating more defensive positioning, this suggests that is actually starting to happen, and that's what is causing funds to flow to these 4 defensive sectors. So what we're going to do today is I'm going to talk about 5 stocks, one in each of these kind of classic defensive sectors, and then another defensive stock that's in a not so defensive sector these days, but you'll see what I mean when I get to my last pick. Let's go through each of these one by one. Starting off with the utilities sector. Now, utilities are actually kind of interesting because in 2024, after kind of that, February, March of last year, that's when the AI sort of theme sort of exploded, right? And stocks like NVIDIA and other chip makers, obviously the Magnificent Seven names like Meta and Apple and Alphabet was the one I was looking for, really started to accelerate to the upside and establish themselves as leadership names really through the course of 2024. You also saw big appreciation in utility companies, and this comes from the energy requirements, right? Just the power needs of cryptocurrency mining, of big AI models, right? They require a lot of computing power, and a lot of computing power requires a lot of energy, and a lot of energy comes from utilities companies. So all of a sudden, utilities, which are thought of as sort of like the sleepy, quiet part of the markets, became a growth engine. One of the things I saw mid last year was, and I think it was comparing like the Q2 to Q3 earnings calls or something like that. In one quarter, only 1 or 2 of the utility companies in the S&P were asked about energy requirements of AI and crypto mining. The next quarter, almost all of them in their earnings calls were talking about AI and the power needs. So it certainly became a big theme. You saw an improved correlation between like technology, communication stocks, and utility stocks. However, the fact remains that utility companies tend to be pretty high dividend payers, and they tend to be lower volatility, even with last year's sudden rally. So Clearway Energy is one we're highlighting, and I found this one because of the high dividend yield. It pays just over a 6% dividend yield. And if you're not familiar with the dividend yield, what that basically means is you take the quarterly dividend, you annualize that, so you basically look at 4 quarters of a dividend, and this on stock charts is actually doing a forward dividend yield. So it's projecting based on the historical dividend payments and any anticipated changes. It's projecting what your dividend payments are going to be for the next 12 months. It's no guarantee, but it's an estimate based on the trend in dividend payments up through today, and basically says this is what you're probably going to get over the next 4 quarters. So, your forward dividend for Clearway Energy is estimated to be around $1.67 per share. The stock is currently trading around $27 a share, which means you get about 6% of the stock price back in the form of a dividend, right? So that's what a forward dividend yield is basically doing. So 6% means just buying this stock, again, you'll probably have a bit of a price deterioration because when a company pays a dividend, the stock price comes down a bit. However, it's not a guaranteed income, but you can assume that that's probably a good chance that they're going to pay out those dividend payments. As a result, you have a clear expectation of what sort of income you could get, as opposed to just hoping the price goes higher. So Clearway Energy is an interesting name because of the dividend yield. It's about a $3 billion market cap, so it's really a mid-cap name in the utility sector. From a technical perspective, I would say what's encouraging about something like Clearway Energy is the beginnings of improvement in relative strength. This is what we talked about on that first chart, the relative performance of those 4 defensive sectors. You're seeing with a lot of these names, the relative performance line, looking at the stock versus the S&P, is just starting to turn higher in the month of February. And that, signals it might be early days of a period of outperformance. I would say from a technical perspective, I'm a little concerned with the chart of Clearway Energy because if you look at a trend line from the previous highs, we're kind of below trend line resistance, right? We're in a bit of a downtrend channel of lower highs and lower lows. So I would say from a technical perspective, breaking above this trend line resistance, ideally changing this pattern of lower lows and lower highs to higher lows and higher highs, that would be even more constructive. Because of the high dividend component, I think it's an interesting name to consider right about now. And I would say look for a breakout above trendline resistance as maybe a further evidence of price appreciation to match the income side of the coin. The second of the 4 defensive sectors we highlighted on that first chart was the healthcare sector. Now, healthcare is kind of a diverse sector, to be honest with you. You have more defensive areas, more low volatility areas like pharmaceutical companies, especially established pharmaceutical companies tend to be more blue chip kind of names. But you also have biotech, you have life sciences, you have medical supplies, medical equipment. There's actually a bunch of different names that are all bucketed within healthcare and all related, obviously, but very different dynamics in some of those groups. I want to highlight Pfizer. Now, from a technical perspective, Pfizer has not been a particularly great chart. Certainly through the first half of 2024, this was a stock that spent most of that time below 2 downward sloping moving averages. And for me, I would much rather own things that are above 2 upward sloping moving averages because that tells us that the primary trend is positive. But what's interesting from a technical perspective on a stock like Pfizer is that it is finding support at the previous lows. Look at the low from December 23, from April 24, from November 24, all right around that $24 level. And this is on an adjusted basis, but you get the idea. We sort of bounced off of an established level of support as we became oversold in each of those instances. Now we're actually breaking above that previous low. So we found support, we're trading higher. Now we're sort of in that no man's land between support around $24, the 200-day moving average around $27, which also lines up with some of these previous swing highs in January, right? So we've bounced up to the 200-day in early January and late January, now again in late February. I think if and when we can push above that 200-day, if and when the RSI can push above 60, that for me would be the trigger signaling something's new, something's different, what we call a change of character on the chart of Pfizer. Now, as we're waiting for those signals, remember, this is also a stock that pays a 6.5% dividend. That compares to the S&P average, probably 2 to 2.5% or so, depending on where we're at in the cycle and what's happening with all the individual members. But obviously much better than average compared to the benchmark. So Pfizer is chart number 2, and again, from a technical perspective, I'd be looking for a breakup of the 200-day to complete that upside rotation. But I like the fact that since it's trading so low relative to the last couple years, the dividend yield is pretty decent. And if we can hold support, this might be an interesting way to ride out periods of market uncertainty. As I mentioned earlier in the video, thanks to my friends at Seeking Alpha for supporting the channel and supporting this video. I would say, I'm a big fan of the Seeking Alpha platform, particularly their quantitative models. I actually interviewed Steve Kress, who created the quant model on Seeking Alpha years ago, on my podcast called the Market Misbehavior Podcast, and I'll include a link in the description below. If you missed that discussion, I'd highly recommend you listen to Steve, how he created the model, how he thinks about quantitative models relative to all the other tools you can use as an individual investor, as a financial advisor. So I'd encourage you to check that out. 2 scans that I actually use, and this is in the stock screener portion of Seeking Alpha, was top quant dividend stocks. So these are stocks with high quant ratings according to Seeking Alpha's model, particularly in the area of dividend growth, dividend consistency, because one of the things you'll find is sometimes companies will do a one-off dividend or all of a sudden just get rid of that dividend. And that happened a lot sort of coming out of the COVID era. You had companies that were struggling with a cash position, so they just basically said, we're hitting the pause button on our dividends. So dividend consistency is an important thing because that gives you more confidence that those estimated dividend payments are probably going to come to fruition as you expect. So that's one screen that I think was a really good place to look. The other one's the high dividend yield stocks. These are going to show you companies paying over 6% dividend rating, but also score well using the Seeking Alpha quant model. And what using a quant model means is basically you are looking back through market history, looking for the types of conditions, the qualities that have demonstrated their leading companies, right? That companies have done well after a particular set of conditions based on fundamental technical criteria. A quant model basically scores stocks based on those fundamental and technical criteria and basically says, here are the names that are looking the most like companies that have tended to do well in previous market cycles. So companies that pay dividends with strong quant ratings, really good, interesting place to look as sort of a proving ground, as a way to fill up your watch list with some actionable ideas. I also do want to let you know, by the way, if you join Seeking Alpha, you will have access to their Dividend Investing Forum, which is an event coming up Wednesday, March 5th. It's an online event, so you can join from anywhere. And if you're a Seeking Alpha member, you'll be able to participate in that event. Steve Kress, the head of the quantitative strategy, also with some guest speakers focused on dividend payers, on dividend quality and dividend consistency, helping you think about the dividend part of your portfolio along with other things you might be normally looking for, like growth, etc. This could be a great event to answer some of those questions for you. Again, if you join Seeking Alpha, you'll get all the information. You can sign up for Seeking Alpha today if you go to marketmisbehavior.com/Seeking Alpha. If you use my link, which I've included in the description below, or just scan the QR code that you see, you'll get access to a special deal, and makes it a little more accessible for you, and helps me as well to keep this channel awesome. So check it out again. That dividend investing forum is coming soon on Wednesday, March 5th. We'll feature some of the Seeking Alpha experts and some special guests talking about dividend investing, leveraging some of these tools and techniques that we're talking about in the video. I hope you will check out Seeking Alpha, and hope you can participate in that dividend investing forum. Let's keep going here today with the 3 more names that I'm identifying here in February 2025 as interesting dividend opportunities. Clorox is number 3, and that consumer staples sector was the 3rd one that we identified on that first chart of defensive sectors. Now, consumer staples have been absolutely en fuego in February of 2025. This is a sector that has been, one of the worst relative performers in 2024. Generally speaking, food products, home products, personal care products have not been doing particularly well. All of a sudden, names like Clorox and other, traditionally defensive stocks are starting to rally quite a bit. From a technical perspective, I'm a little concerned about the breakdown here of what looked like a very head and shoulders-like topping pattern. You had higher highs, September into December, November, December of last year on weaker momentum. That's called a bearish momentum divergence. We've already broken down quite a bit, and we did spend a week or two below the 200-day moving average. But in the last week, we've now started to rotate back higher. We're threatening to regain the 50-day moving average. So I would say from a technical perspective, this neckline, which is right around $155, if we can break above there, which we have, and hold it, which would be my question, then I think this, from a technical perspective, all of a sudden looks like a compelling opportunity with the potential to retest those previous highs from Q4 of last year around $170. If the momentum can improve, if the RSI can push above 60 as we continue to appreciate, I think that's a good opportunity in a name that yields a little bit more on the dividend side than the average member of the S&P 500. The 4th stock is in the 4th sector, real estate. REITs tend to be lower volatility. They are known for having good dividend components because the business is really more of an annuity business, right? I mean, you own a property and then you get the monthly mortgage payments or whatever it is, or monthly rent payments. So as a result, real estate tends to be one of those good income strategies when market conditions are struggling. VICI, Vicky Properties, I'm probably pronouncing that wrong, but I'm mentally going back to a true story. I took Latin at Ohio State. I used to work all night as a night guard at a dorm. And if you know me personally, and I'm sure many of you don't, but if you do, I am probably the least threatening night guard you could come up with. Number one, because besides the fact that I'm fairly tall, I am not a big, strong guy. I'm a little more laid back and pretty chill about things. So I'm not going to stop you if you're really trying to threaten things. And also, I tend to fall asleep. I'm a morning person. I'm not a night person. So between you and I, now that I think I'm past the statute of limitations for poor job performance in my late teens and early 20s, I used to fall asleep all the time on that job. But it paid pretty well because no one else wanted to work all night. And the whole point of that story was to say that I took Latin at 7:30 a.m. So no joke, I would work all night and then go take Latin. I'd go right to class. So I don't remember a lot of Latin, but I remember VICI as Vicky, which I think is I conquered, I want to say. I believe that's true. Vici is how a lot of people, that's the Italianized Latin, but we digressed. All right, looking at the chart of VICI, we'll go with tickers from here on out. You can see we've rallied really well from $28 a share up to just above $32 a share this week on an adjusted basis. What's encouraging about this chart is that similar to Clorox, it had broken below the 200-day moving average but started to recover. The momentum was negative with the RSI consistently below 60, and that's telling, right? In a downtrend phase, you will find these counter trend rallies where we bounce higher, but the RSI stalls out around 60. That's why I often say you want to see the stock with the momentum push above an RSI 60 level, because that tells you maybe a new impulse move to the upside, maybe a change of character. And that's definitely what we're seeing, as Clorox is now threatening to overtake a previous high, 52-week high from September of 2024. Again, this is a stock that pays an above average dividend, as is very common in the REIT space, just over 5% dividend yield. So strong price performance, strong dividend. That's the 1-2 punch of what I think could help you to survive and thrive in a period of market instability. Final stock out of the 5 dividend plays that I'm looking at here in February 2025, a classic high dividend name, AT&T. Now, I mentioned this is not in a defensive sector. It's in communication services, which is the same sector as Meta and Alphabet, a bunch of internet stocks and media names. But you have to remember that AT&T used to be a part of the old telecom sector. Before they made communication services, they had the telecom sector, which was like AT&T, Verizon, and then like some smaller cell phone companies, mobile companies. And that was kind of it, right? It was just kind of the smaller sector. It was a very small part of the benchmark. Maybe like 2% of the S&P were in these was in this sector. So it was very, very small. And eventually, AT&T and Verizon and these other names got bucketed into the new communication services sector a number of years ago, combining media. So they took stocks from technology, consumer, and telecom, and made this new communication services sector, which makes sense. But AT&T is often known as being a fairly defensive sector. Even though they have some offensive parts of the company, it's a pretty diverse business these days. It's still sort of the old telecom sort of feel. What's fascinating is out of all of these charts that I've shown you, AT&T is the only one that's really been in a consistent uptrend for quite some time. I mean, AT&T had actually a pretty strong 2024, and even though it was a market performer in the first half of last year, the second half of last year was actually remarkably strong and outperformed during that period. So far, early days of 2025, it's done even better. We had a nice pop here late January, continued to accelerate. This is what we call a gap and run pattern, where we gap higher, and instead of just selling off, we actually continue to push higher. So when a stock gaps higher and then you see a bunch of additional buyers come in, this is what propels prices to further upside. If there's a concern about AT&T right now, it's the fact that it's really overbought. It's had a really good run. And what that could mean, similar to what we saw in like September of 2024, stocks can correct in one of two ways: price or time, right? It can correct in terms of price, meaning we give back some of the previous gains, or correct in terms of time, which means we sort of stall out and hold steady for a while before we continue the uptrend. That's what happened in September of last year. We were very overbought. We ended up being sideways for a couple weeks and then continued the uptrend. And maybe we're going to see a similar configuration. Wouldn't be surprised if we get a pullback, especially if we come out of that overbought region. However, I would say the strength in price, and again, a strong dividend component, makes it a compelling opportunity here in February of 2025. So there you go. Those are 5 dividend plays, my favorite dividend plays for February 2025. And again, the way that I identify these is by using the Seeking Alpha platform, by looking through some of those defensive sectors and identifying strong price characteristics, strong technical configurations, or potentially developing strong technical configurations, but with the dividend component, the higher dividend yield, which suggests that it could be an interesting place, an interesting opportunity to ride out a period of market instability. If you want to use those Seeking Alpha tools for yourself and identify some good dividend opportunities, also participate in that dividend investing forum coming up on March 5th of 2025. Make sure you sign up for Seeking Alpha. You can find more information at marketmisbehavior.com/Seeking Alpha. And again, I appreciate you using my link. Makes it a little better deal for you, and certainly helps me to make Market Misbehavior awesome. That's it for today. For Market Misbehavior, I'm Dave Keller. Have a great one, and remember, it's always a good time to own good charts.